can you hear me? Just let me know. Just post something on the chat. Brilliant. Okay. All right, guys. So we are live. We are ready to go. Last show of the year. Really want to thank you for just your support throughout the year. I know a lot of you guys have come in at different times. Some have watched directly on this stream. Some have picked it up on replays, etc. So want to express my sincere gratitude to all of you, whether you've participated in questions or not. The fact that you do log on is something that I sincerely appreciate. So I was kind of saying to myself, what's like the best idea that could have come out for the year? Thanks, Louis. Appreciate that. You know, what can I leave with the guys? We've covered many things. We've covered strategies, trend reversals, major trend reversals. We've covered risk reward probability of the traders formula. We've covered measured moves, all sorts of things. We've expanded triangles. The list is endless. But when I considered what I think is probably the thing that has stood out for me the most, is the switch that I have made from trading predominantly off the 20 EMA to trading off the 10 EMA. So from the 20 EMA to the 10 EMA. And the reason why I think that's important, just to kind of highlight as a key takeout, which all of us can use, whichever way that we trade, is the thinking and the rationale behind it. Now, the 20 EMA, if you read price action, or if you trade using price action, you will notice that of all the time frames, the market tends to come to that level and react off it, bounce off it, giving you an opportunity in a trend, or might just create a trading range and then opportunity for a trend reversal, you know, which allows you to get into a trade and, you know, hopefully get some good profits out of a trend reversal. But my decision to go from the 20 EMA to the 10 EMA was based on pretty simple realization that as a price action trader, we always draw in lines, right? Support levels, be it, support levels, horizontal levels, be it support, okay, price coming down to bounce off it, or be it resistance and the market bouncing off that level. So we always draw in lines, but we also draw in trend lines because we want to see that trend line, you know, the market going up the trend line. And then if it breaks through that trend line, we start thinking, oops, are we entering into a trading range or a potential reversal? Even if it's a bear trend, we're always looking for trend lines. Then I noticed something that it was just probably purely accidental, not much science into it. One day I plunked in just different shorter EMA, shorter time frame EMAs. I had a 12, I had an 8, I had a 10 over a period of time, and I realized 10 EMA almost approximates the trend lines that I was drawing. And that for me was just such a beauty because it took off a bit of work off me, because I realized if I put the 10 EMA on, I don't have to go and draw trend lines again because they're almost overlapping each other. So at some point I had both 10 EMA and the 20 EMA, looking for my trades off the 20 EMA. And I realized that the strongest part of the trend breakout is above the 10 EMA. And the more I started studying that in live market situations, you know, I realized that if I can focus on executing trades in the stronger part of a trend, be it a breakout and follow through, I have a lot more opportunities to get in when there is momentum. Okay, that pullback to that 10 EMA is typically one of the first pullbacks in a strong breakout. The market can then come back and pull back again and bounce off a 20 EMA. Fantastic, still take that trade. So I think just in terms of trying to close the year, everything that we've done, bring it all together, you know, everything that we've covered, bring it all together. But if you want to go forward and say what could be the easiest way to trade and earn some good monies for yourself, that pullback to the 10 EMA is something that you have to be actively looking for. Then everything else is confluence, right? Always look for confluence of factors, support, horizontal level of support, resistance, measured moves, anything else that confluence in that area, just to give you a little bit more confidence to take the trade. But the pullback to the 10 EMA is absolutely something that we're going to try and build into the way that we trade. So that's a big takeout for this year. We're going to just go through some charts so I can just, I'm not going to do a full analysis. I'm not looking for measured moves. I'm not looking for anything else. I'm just going to show you. Hang on, look, there's a pullback to the 10 EMA. So if there was a confluence of factors, boom, we need to be jumping in. And you see that they literally are all over the place, right? That's what we're looking for. What it also does for us is this thing that I've spoken about quite a lot: patience. We just gotta wait and wait, and when the time to execute comes, we have to execute and jump in. So bear in mind what we've kind of hammered on. We start off with a higher time frame, and we get to down monthly, weekly, to our daily. And when we see a setup on the daily time frame that the daily traders will be looking to trade, we want to go down to the 5-minute time frame and just optimize our profits when we're down there. So let's have a look at that 10 EMA as a key takeout. This is Nikkei 225, top 225. Let me just do this so that we can scroll it back. Top 225 companies trading Tokyo Stock Exchange. If you just have a look at that, this is a 10 EMA. All you want to get your eyes to see is, okay, there is a breakout taking place out of something here. Okay, it's coming off the 10 EMA, but let's look at after the breakout, confirmed breakout, pull back, we're coming back here. We should be looking at ways to jump into a trade here. And of course, we take our profits, measured moves. Okay. Even if you just see one particular setup, okay, I'm looking for specifically trades that bounce off before breaking through the 10 EMA. When it breaks through, we can plonk in the 20 EMA and find other opportunities. But there is a particular trade that you have been interested in. If you've been tracking the reversal all the way down here, you would have been interested in that, but higher risk because you're top of a trading range. If we have a look, so there's the reversal form there. We're not going to worry about looking at the fullness of that reversal, but have a look at what's happening this side. 10 EMA, an attempt to break and close above it, which is an attempt to break the momentum of this particular trade. Breakout by the bears, okay, breakout candle, pull back, fail to close above the 10 EMA. You need to be finding a way to get into that. Okay, when it starts to do this, you can put the 20 EMA, but we're not worried about that at the moment. Okay, so looking for trends and bounces off the 10 EMA. I mean, if you look here, okay, 3 push pattern, 1, 2, 3. We've spoken about that quite a bit. But you want to look at the closes above the EMA, 10 EMA, and where your stop would be, somewhere down here. You always put stop in a correct technical position. Trades you want to take, okay? If for any reason, again, you put your stop beneath here instead of the, let me not say the correct, but put your entry beneath here and you haven't taken a profit measured move, which you should have done. If you haven't taken a profit measured move, you might get stopped out. Okay, so bring everything together. Take a trade off the 10 EMA, measured move where you take your profits. Okay, have a look here. Okay, so a key thing, what do you want to look for? We're looking for where there's a breakout. We're looking for the first pullback to the 10 EMA. Why the first pullback to the 10 EMA? Because we don't like to trade breakouts. Most breakouts fail. Okay, if you're going to take a breakout trade, you need to have a wide stop. And the question is, what's the point of doing that? Because most breakouts fail. However, if you see a confirmed breakout, you want to wait for the first pullback to the 10 EMA. That's why we're using the 10 EMA, because it's an indicator of the strength of a breakout. And that's the one that we want to execute. That first pull back to the 10 EMA. Okay, if you put the 20 EMA, it's a different story. So breakout out of something here, trend reversal breakout candles follow through, pull back to the 10 EMA. That's where you want to be executing. Measured move, you see where you take your profits. Breakout, first pull back to the 10 EMA, comes in here. Okay, that's the first pullback to the 10 EMA. That's where you want to take your profits, then look at measured moves, etc. Or, if you want to hang on and see if a full measured move to get down here. But we're looking for the first pullback to the 10 EMA. Okay. I mean, if you ever look at this trend reversal, we're not analyzing that at the moment. We're looking for a breakout and a pullback to the 10 EMA. We don't get a strong enough breakout here. Okay. Yes, the market is beginning to move down, but we're looking for those successive bear candles. We get them here. Okay, once we get them here, we're saying, okay, let's wait to see the first pullback to the 10 EMA. There's a first pullback to the 10 EMA. That would have been a little bit problematic because it's almost an outside candle. And outside candle, when you're trading that, you got to be thinking, well, it is almost an outside candle. You got to be thinking, well, that could be just a trading range forming. So you're taking that trade, you need to stop way out here. But that qualifies as a first pullback to the EMA. Okay, trade that you can take. You have follow through pullbacks to the EMA, etc. that come through, but we want to jump into the first pullback to the EMA after we get a breakout. Market goes sideways. Here we have breakout candle just beneath that, follow through first pullback to the EMA, 10 EMA right there. So we're talking about finding a breakout out of something. Okay, it could be a trend continuation reversal. Then we want the first pullback to the 10 EMA. That's a trade that we always want to be looking to take. The one-to-one measured move take profit must be large enough to cover the spread. Yes, good point. But you also got to bear in mind, you got to find markets that are liquid, right? Which means your spread is smaller. I live in South Africa. I don't trade the South African rand because of this humongous spread they have. Even if they have beautiful moves, don't even look at it. So if you trade size correctly, your one-to-one move ought to cover that. If it doesn't, and you are short 0.8, 0.5, whatever the case may be, that is perfectly fine. You're going for your measured moves. Measured move theoretically would mean you should get a one-to-one return. But good point, and aim for the low spreads markets. Go for the high volume markets. That's what I would recommend. Yes, the 10 EMA is applicable on all time frames. Remember, so the way to think about the 10 EMA is indicating for you the strength of a breakout. That's the way to think about it. So you want to find, okay, if we strip off the 10 EMA, let's do that here very quickly just to indicate the point. So I delete the 10 EMA. If I came into this market without if I'm not using the EMA and I say, okay, George, what's happening? Well, I've got to try and find out where are the trend breakouts. Okay, that's the first thing I look for. And I kind of look at it and say, okay, the market was breaking down there. Okay, market broke down here. Just want to find where the trend lines are there. If I was to do it this side, bulls. Okay, so all I'm trying to find is let's plonk it back in. Okay, So you can see the closer approximation. What I'm trying to find is where is my trends. There's a trend, there's a trend, there's a trend, there's a trend. So instead of drawing all these lines and then cleaning up my chart so everything looks clean and neat, I found that if you just plonk the 10 EMA, it's a close approximation. Now, if we go to 50-minute time frame, good Lord, why is she jumping around? Okay, go to the 50-minute time frame. Okay, so that's a 50-minute time frame. And you can see, again, same kind of thing. Where as long as the trend is strong, right, our 10 EMA is giving us a close approximation of the trend line. So it would work out the very same way. If you then wanted to put back the 20 EMA, which, okay, I'm not saying we don't trade the 20 EMA. That is still somewhere where we can pick up trades. But the objective of putting the 10 EMA is to try and find where the strongest part of the trend is. Okay, so there's the 20 EMA. Again, you'll be taking trades off the 20 EMA if you wanted. So it doesn't matter what time frame you are trading off. It's a tool that we can use, so I'm reading questions while I'm answering. It's a tool that we use to find the strongest part of the trend. What EMA do you use for? So whatever time frame you're trading, okay, if your objective is to say, I want to jump into trades where there is momentum. Okay, so there's been a breakout. I can see the market has pulled back. On that first pullback in the breakout, put the 10 EMA on. And then at that point of the pullback, of course, you look for other things, confluence of factors, other levels of support and resistance, measured moves, etc., things we've spoken about. So you can use the 10 EMA on any time frame. That's the point. Okay. Now, I'm not sure if that answers you. So in terms of identifying the strongest part, yes. Now there's other EMAs that you can use, 50 EMA, 200 EMA, confluence. All of those are EMAs that the market tends to look at, and you're using those as part of the confluence of factors. Okay. My decision is the goal is to make money. That's the goal. And if I'm going to make the most money where there is that momentum, that's where I want to get into. That's why that's where the 10 EMA would come in pretty handy for us, because we want to jump in and just really optimize our profits. Okay. Yes, there will be bounces off the 20, off the 50, etc., and you can keep on picking up profits as you go along. But if you've gotten in at the beginning, and of course, got the other discipline of letting your profits run, that's another completely different story, which is what you must do. If you can get in early and hold on to the trades, you optimize your profits. Our goal should not just be to make 1-to-1 or 2-to-1. We want to make the 5-to-1s, the 10-to-1s. We want to make big money. We want to create wealth out of this. Okay, so just check on. Okay, good point. All right. All right, let's just pick up another one. Okay. UK 100, which is that derivative or close approximation of FTSE 100. Okay. Point is, you're waiting to see there's a breakout. When you see the breakout, then you want to look to jump into the trades. Okay. There's a gap down. That's the morning, end of the 17th onto the 20th, etc. When you see a gap down, what it actually means, just by looking at it, it's a big bear candle, right? That's what's happening. We've sold down all the way here. Then you're looking for the pullback. Now, there's all sorts of complexities in trading when the market opens. So just put that aside, because there's other things we must bear in mind. But a gap down is a big bear candle. A gap up Market went up. It's a huge bull candle, which shows momentum in that direction. So watch out for possible reversals. But we said, hang on, if the bears are that strong, they did that towards the end of the day. Okay. End of the 17th, and we're coming up over the weekend, gap down, pull back, first pull back to the EMA. Let me look for opportunities to the 10 EMA, opportunities to trade. Okay, if you didn't trade that because it's open, you weren't worried about open reversals, you wait a little bit, you see another breakout, bear candle follow through, pull back after this breakout, first pull back to the 10 EMA. Those are the trades you want to take. And of course, we hold on to our trades and see what happens. Now, this other side is interesting. Okay, reversal, not looking at that with a strong bull trend. But in here, we didn't get an opportunity to get a pullback to the 10 EMA. Down here, after this reversal, would you have taken that? Well, if you're looking at major trend reversals, possibly not. You want to wait because that could just be a test of that. But in any case, no opportunity created for us in here. The first pullback that comes to the 10 EMA, and that's a good point here. The first pullback that comes to the 10 EMA is a double bottom, is a higher low. Now, which pullbacks are we looking to trade after the breakout? Okay, we're looking to trade the first pullback after the breakout. With the 10 EMA, we're looking to trade for the first pullback after the breakout. I mean, that's a breakout. Breakout could be one candle or two candles. First pullback that comes back to the 10 EMA. That's what you want to trade. Okay, so here, strong bull breakout, market comes back. Okay, we're still within a trading range, doesn't get to the 10 EMA, let it go. It looks beautiful afterwards, but it didn't set up for us. Then we get another pullback. Okay, after this bull breakout, you could say breakout above that high, breakout above that high, follow through, first pullback. Does not come back to the 10 EMA. We let it go. Okay, so we put out our 10 EMA. We want the first pullback that comes back and bounces off that 10 EMA. That's what you want to trade. Can we trade that? When we trade in that, in our minds, we can trade it, but we're no longer trading the strategy that says first pullback to the 10 EMA. Yes, it's a pullback to the 10 EMA, but it's not. It's a double bottom. There's other factors that allow us to trade. So in our mind, we need to have the absolute clarity that my strategy says X. I'm trading this particular strategy. If it doesn't set up, I'm not trading it. If something else sets up that fits into another box of my strategies, pull back to that EMA, but now there's a double bottom involved, I can execute that trade. So have your strategies written down. Depends how much you can juggle in your head. You should have maybe 4 or 5 things that are absolutely clear that this is how I trade. Okay, so if you don't see it in the heat of the moment, if you trade in lower time frame, don't trade it. Okay, if you trade in the end of day and you got time to say, okay, it fits in that. Okay, nothing is ever perfect, but it fits in that. I've got enough confidence of factors, execute. Okay, if it's not in that, don't execute it. Okay, we want our brain patterns, our neural pathways to know that this is how I execute. So we don't want to, it's like walking through the bush. You create a pathway. That's the way that you always go. Okay, until it's grooved and etched. You don't want to kind of go this way and then come back and go this way and come back. Our brain is going to know the signals that say execute and trade. Okay, and we do that just by repeatedly looking at the charts and saying that I would trade, that I would trade, that I wouldn't trade. Okay, sideways price action. I mean, look at this. Absolutely beautiful breakout and just coming off pretty close to the 10 EMA. You could have missed that if you didn't come quite close, but that's pretty decent way to look at a trade. Just want to make sure I don't miss questions. My bias is short. H1 price about 10. Okay, let me see if I understand this. So your bias is, if your bias is short, On the hourly, the price is above the 10 EMA, but the 15, the price below the 10 EMA. So don't, okay, good. So here's what I recommend, Louis. You have to decide which time frame that you are trading off. That's the key thing. It's absolutely perfect to start off on a higher time frame to kind of look and say, okay, this is what's happening, set up here, levels of support and resistance, perfectly fine. Okay. If this is my time frame that I'm trading, a 15-minute time frame, this is the time frame that I'm trading. That's where I make my decisions. If I'm seeing the setup here and I'm saying, okay, let me see. So my stop level is determined by the time frame that I'm trading. I'm trading the 15-minute time frame, so that's where I put my stop. So I know my stop is here based on what I'm seeing. Now I want to find a tighter entry, which means I can go to a lower time frame. So I can go to the 5-minute time frame. I have my 10 EMA there. If I'm going short and I see the breakout on the 5-minute time frame, and I see the pullback to the 10 EMA on the 5-minute time frame, I can execute the trade there. However, the stop is not on the 5-minute time frame because you're not trading the 5-minute time frame. You're just finding a tighter entry on the 5-minute time frame, so you make more profits, but your stop has to be on the 15-minute time frame. So you execute off the 5, but your stop is on the 15-minute time frame. That's way so that you can use a 10 EMA time frame to get into your trade in the direction you want to go. Put your stop on the 15-minute. Don't use the higher time frame, the hourly time frame, to decide, well, I want to trade on the 15. That's you're going to misread the price action. So once you're casting concrete, I'm a 15-minute trader, perfect. I can go down lower to execute trades. I can go higher to find levels of support and resistance. You know, like we do on the daily. You've seen how I start on the monthly, weekly daily, and I put all those lines. And I say that's the daily, that's the weekly. Those stay in view so that when they come up, if I see a reaction there, I'm not surprised. So that's the way to use. So if you do it that way, then you'll be perfectly fine. You'll get tighter stop levels, but manage off the 15. So kind of other way that I look at it, if I'm in a 5-minute trade, and I'm kind of thinking, I think I want to hold this overnight, okay, which I do rarely, 10-15% of the time you can use that. But if it's setting up, I want to try and maximize the profits, right? So if I look at it and I say, okay, I want to carry my trade over, the challenge, I got to change my thinking around where my stop is, because now I'm trading the daily time frame, okay? And whatever I've done during the day to execute the 5 minutes is just a tighter entry on the day. So if I want to carry the trade over, I need to flip over to the daily and say, where is the correct place to put my stop? And then the only way to, or not the only way, one of the things that I look at is, so I'm close to the end of the day, where is the 50%, or is the half of the day's trading range? Let's say high, so I'm going short, high of the day, low of the day that I'm in, and I'm somewhere here, and I'm thinking, listen, the market is closing down here. There may be more momentum short tomorrow. So I want to get off a trade and get up and try and find ways to get in, if it might just keep on going in my direction and maximize the profits. But because I'm now thinking of carrying the trade over, I look at the day and say, okay, there's the high of the day, low of the day's trading range. Where's the 50% of that trading range? Because I know there's a greater chance that by the time when the market opens, it's not just going to go drop. It might, but it might just pull back, a little bit and test the 50% level of the previous day. So I want to put my stop to there. That's a completely different decision. By that time, you'd have banked some profits. Okay, then if you put your stop there, it pulls back and stops, so that's fine. But sometimes it goes back and then just turns and goes in your direction. But you're making, if you start to switch over, so if you're kind of looking at the 15 and start to switch over to the hourly, then it's going to be an hourly stop. Changes the dynamics a little bit. Okay. All right, guys, good questions. Keep them coming. So I'm just want to emphasize, I really think whatever you do next year, if you can bring in the 10 EMA into your trading, you will be pleasantly surprised at what you get. Okay, so kind of scroll back a few. There's no other huge opportunities on the UK 100. That's perfectly fine. We go to another chart. S&P 500. Well, let's go to euro. Let's look at some currency. Isn't this fascinating? This this is the open of the day. I mean, this is the red news territory that I was talking about. So if you trade into the holidays, just exercise caution about where you put your stops and what happens in the market. Now, there is a strong bear breakout. Okay. I was about to start talking about wedges. We're not analyzing that. We're just looking for our pullback to the EMA. First pullback of this breakout. Okay. Strong bear breakout bouncing off that low. First pullback is this tight trading range that comes back to the EMA. It doesn't give you much opportunities to jump in. So probably wouldn't have taken it. If you had, for any chance, your stop loss to appear, but I wouldn't have taken that. It's another little thing to talk about. So there are several types of pullbacks to the EMA that you will see quite often. Any EMA, 10 EMA, 20 EMA, 50 EMA. The best one, I have to correct myself, it's not like best one. The cleanest one that we're looking for is when the market, there is a breakout that you see, and then there's one or two candles that pull back to the EMA and bounces off. The EMA gives you a high test, low test, classic stuff, and then we execute that. But you can also get variations of pullbacks and get a trading range pullback like that. That's a trading range pullback to the EMA. That's fantastic because you gotta just think of trading as a trading range, which means you'll be looking for entries at the top of that trading range, looking for acceleration down. You can get wedge pullbacks as 3 push pullbacks to the EMA. So just bear that in mind that there's different ways that the market can pull back to the EMA, which gives you an opportunity to take the trade. Okay, so our goal is to try and find these exceptional, these strong pullbacks to the 10 EMA. And when we see that, that's what we execute. Okay, so in here, trading range, breakout, pullback. That's almost like what I'm trying to get a decent enough pullback. I mean, that's after this little breakout here. This is as decent as they come. Cleanly off the 10 EMA, order beneath here, stop above here. Okay, that's where you put your stop. If you want to be conservative, you can always put it up there and then wait for a measured move. So that's a decent enough entry. Then we get another breakout, pull back to the 10 EMA. There's another entry that you could trade, okay, and stop above there. I mean, on that particular day, if you're trading with trailing stops and all of that stuff, so this is about middle of the afternoon. And if you just let your profits run, I mean, you could make enough money just off here. You don't have to trade for the rest of the month. Another breakout, okay, breakout follow through, pull back to the EMA, not as clean because we have another little pullback in here. So when you trade in here, you're not trading the first pull back to the EMA after the breakout, but you're trading, double tops of the EMA, ways to get in and just hold your trade down. Okay, so my recommendation is, you kind of just go work this out and have a look out for yourself and see the opportunities that are there in trading the first pullback to the 10 EMA after a breakout. Okay, the only reason we're doing that is we want to jump into the market when there is momentum. Okay. I don't think I've spent a lot of time talking about trading breakouts because most breakouts fail, but I look for breakouts. If I see a confirmed breakout, then I want to see that pullback to the EMA. So in this one, I mean, whether you got in there with the major trend reversal or something else, but then after waiting and waiting, and you say, okay, there is a breakout, this candle is broken out beneath that, there is a follow through. Let me wait for the first pullback of that to the 10 EMA. You get a pullback in here, which you may have said, not crystal clear, let me not trade that. If you don't take that trade, then you're looking for a different, still pulling back to the 10 EMA, but it's no longer the first pullback to the EMA. Now you're trading a double top at the EMA, free push pattern, fantastic ways to get in. You could still take that trade, okay, and then just wait until hold on to the trade. So the takeout for today that I want to just leave guys with is there's a lot of stuff we've covered in the year. It's been really fantastic. But I think one of the easiest ways that you can capitalize on the market is to try and find out when the market is breaking out, into a new trend. And when you see that breakout, just be patient, wait for that breakout to kind of finish the first phase of the breakout, so the breakout and the follow through, or one huge breakout, and wait for the pullback to the 10 EMA and execute. You can do that after news breakouts. You can do that at any time in the day. But then bit of confluence of factors, see where to put your stop, jump in, and try and hold on to your trades. Now, onto the point of holding on to your trades, 2022, we're going to carry on looking for trades, and hopefully we all make a ton of money. But how do we make a ton of money? It's really something that's close to my heart that I want to bring into my show next year. There's three things that will help us to create wealth, real wealth in the markets. I mean, we invest in time in the markets. We are learning how to trade. We don't just want to beat the bank. I mean, yeah, we know that out of on your US dollars, you may not get 3% a year, in the bank. We don't want that. We want to exceedingly beat the bank. We want to make huge returns. The way you're going to make it is three things. We have to master how to read price action. Okay, whichever way you trade, doesn't matter whether you put indicators or not, or algos, doesn't matter. But we have to know how to read the market. So that means just looking at the charts and over again. The second thing is we have to know how to manage ourselves. The mind that operates in us, in your whole being, in your spirit, your soul, and your body. Call it whatever, psychology, but we have to know that because we'll bring that to the market. I mean, the market is a force. It's got bulls and bears, it's got ups and downs. It's a living entity, but we bring ourselves into the market. So if we know how to read price action, execute our trades, we know how to manage ourselves as we come into the market, we are poised. And then the third thing, which for me is really key, is money management. I mean, we all come in with a bag of cash. That's our equity. And irrespective of the market that we trade, if we don't know how to manage our money, the numbers game around the money. When do I trade 0.5%, 1%, 2%, 3%, etc.? What happens when I get a drawdown? When do I scale back and trade less? All of those things are in this pot called money management. And for me, I've really invested a lot of time in it, because you can be a pretty good trader, but without knowing how to manage your money, how to play the numbers, the equity game, you won't be able to get that geometric growth, the scaled up growth in profits, which is what we all need, right? So I'm pretty passionate about those three things, you know, the price action, the mind that you bring to trading, and money management. So we'll kind of fuse that together as we come in next year. But you know, I kind of think if you've come so far in just following this particular show and other shows that ATW has got for us, you're getting to master the first part. You know, looking at charts and saying, okay, this is how I can make money out of this, my strategies, etc. But at a point in time, you also need to be able to look at your baskets of strategies and say, okay, in my basket of strategies, for example, I know when I'm trading pullbacks, there's at least a 60% chance of success with my pullback strategy that I'll be able to make a 2-to-1 return minimum on my pullback strategy. So that's as a base. But then I also know that I have another basket of strategies which are in my trend reversals. And if I work my major trend reversal correctly, for example, there's a whole major trend reversal setup here. If I work out my major trend reversal correctly, and I execute it, I should be able to make a 4-to-1 return, you know, by letting my profits run. But I need to know how to do that. That's not talking about the money management side of the game. When you put all of those together, you can take a small amount of equity, whatever you may find is small, and that can grow astronomically in the course of a year. And that's what you want to do and focus on as we progress. So, guys, I really appreciate your time, and thank you very much, John. Thanks for your comment. Thank you for being here throughout the year. Thank you, guys. I know I won't be able to mention everyone by name, but you've kind of sat through, listened to my jokes, and I know we've laughed along, etc. Thank you, and I really, really appreciate it. And the guys in the office, Actions to Wealth, will tell us about the schedule for next year. And I look forward to catching up with you guys. Let's have fun. Let's make a fortune out of the markets. It's all there. Thank you, guys. Have a restful, festive season, and we will catch up in the new year. Thanks, Louis. Cheers, guys.